Welcome to vTalkInsight, Market Drivers Daily for June 18, 2026. A newly hawkish Federal Reserve, a fragile truce in the Gulf that is pulling oil prices down, and an AI capex boom are pulling key asset classes in different directions. Today we connect those threads and ask what the new mix of tighter policy, cheaper energy, and expensive growth means for risk assets. The core macro story is that the Federal Reserve has moved from debating cuts to openly preparing markets for further tightening, while offering far less explicit guidance than in previous cycles. Rates are being repriced higher at the front end. The dollar has strengthened, and yet equity futures remain firm, suggesting the policy signal and risk appetite are not fully aligned. Recent communications from Chair Kevin Warsh in the latest meeting show a clear priority on restoring the 2% inflation target after 5 years of missing it. 9 out of 18 committee members now see hikes as the next move this year, with some projecting multiple increases, and traders have dragged forward expected liftoff from early next year to as soon as the coming months or October. The 2-year Treasury yield has surged above 4.2%, posting its largest Fed day jump in roughly 15 months, and the 2-10s curve has flattened to its tightest levels since early last year. That bear flattener, combined with a renewed upswing in the dollar, signals markets are taking the hawkish rhetoric seriously, even as they still price only about 1 to 1.5 additional hikes rather than a full-blown new cycle. This shift is not only about the level of rates, but also about how the Fed communicates. Warsh has effectively ended traditional forward guidance, emphasized data dependence, and launched task forces to re-examine the policy framework and balance sheet strategy, all of which raise uncertainty around the reaction function and point to higher volatility, particularly in the 2-year sector. Transmission into the real economy remains uneven. Real rates are elevated, and the Fed is still running down its holdings of mortgage-backed securities, keeping housing conditions tight and discouraging both first-time buyers and downsizing retirees, while at the same time broader financial markets, led by AI-related equities, do not feel especially constrained. Even after the hawkish surprise, U.S. equity futures are trading higher, small caps and chipmakers have rallied, and European tech has been relatively resilient, while more rate-sensitive sectors, such as European gold miners and UK homebuilders, remain under pressure ahead of the Bank of England decision. This pattern reinforces the idea that markets currently interpret higher yields as a byproduct of economic strength and a potential soft landing, rather than an imminent policy mistake. The counterpoint is that several disinflationary forces are gathering just as the Fed turns tougher. Oil prices have dropped sharply on progress in the Iran file. Gasoline is back below $4, and falling energy, fading semiconductor bottlenecks, and lower goods prices could shave around 1 percentage point from core inflation in the second half, while 5-year inflation expectations have slipped below levels seen at the onset of the war. Looking ahead, the focus is on incoming data rather than Fed promises. Today's U.S. jobless claims, upcoming PCE inflation and consumer sentiment, and the Bank of England's rate decision will act as live tests of this new framework, with front-end yields, the dollar, and equity risk premia likely to react more sharply to each release than in the old forward guidance regime. That backdrop sets the stage for how geopolitical shifts in oil feed back into the inflation and policy story. The second major driver is the fragile but market-moving reset in the Gulf following the U.S. Iran interim agreement and the related memorandum of understanding. The reopening of the Strait of Hormuz, currently with toll-free commercial passage for 60 days, has taken the oil market from crisis mode to cautious normalization and is a key reason energy is no longer amplifying the Fed's inflation problem, at least for now. Oil tanker traffic through Hormuz has picked up, with several supertankers carrying millions of barrels signaling that Gulf exports are coming back. Qatar expects LNG flows to reach around half of normal within a month and roughly 80% within 2 months. Kuwait Petroleum plans to accelerate output, and markets anticipate U.S. waivers that would allow more Iranian crude onto the water. Brent is now trading in the high 70s to low 70s range, down more than 2% on the day and roughly 10% from recent highs, while gasoline prices sit below $4 and crude has slipped under 75 at times. This has weighed on energy sector equities in Europe, contributing to underperformance in indices such as the FTSE, even as airlines, Asian stocks, and other fuel-intensive cyclicals benefit from cheaper input costs. However, The structure of the deal leaves a complex risk premium rather than eliminating it. Iran secures significant concessions, including access to frozen assets, eased oil sanctions, and room for missile development. And it emerges with more leverage over Hormuz access, especially given language that hints at a possible fee or toll regime once the initial 60-day free passage window closes. At the same time, buffers are thin. Cushing inventories are at their lowest levels since 2004. Much of the recent price decline reflects aggressive destocking by physical and financial players, and estimates suggest oil closer to $80 to $85 is needed to incentivize new investment, raising the risk of an undersupplied market if demand surprises on the upside. This leaves an asymmetric setup, short-term relief for inflation and risk assets, but significant upside risk to prices if the agreement unravels, if nuclear or regional issues flare, or if shipping delays reemerge. In response, some capital is rotating into real assets such as energy, gold, and uranium as protection against geopolitical and macro shocks, while safe haven financial centers, including Swiss private banks, report renewed inflows from Middle Eastern wealth-seeking diversification. How this delicate balance in energy feeds through to inflation and AI-driven sectors brings us to the third theme. The third driver is the AI trend, which has matured from a narrow U.S. megacap story into a broad, capital-intensive investment cycle that now shapes index-level earnings and sector leadership. Hyperscalers and large platforms are planning enormous data center and infrastructure outlays, with expected spending running into the hundreds of billions this year and toward $1 trillion over time, supporting a powerful tailwind for upstream suppliers. Semiconductor and infrastructure names are clear beneficiaries. The Philadelphia Semiconductor Index has hit record highs with all constituents in positive territory. Chipmakers such as NVIDIA and Micron are driving equity gains, and investors are rotating out of software and services into hardware exposure amid strong AI-related demand. Beneath the index level, AI is reshaping industrial and healthcare workflows. Physics-based AI models allow semiconductor manufacturers to cut process configuration times from 6 to 9 months down to just a few days. German industrial firms report efficiency gains of up to 30%, and AI-driven automation could trim internal process costs by as much as 40%. Even as AI tools in healthcare are projected to add around 9% to sector costs by 2027. Regionally, Europe is leaning into what some call physical AI, combining advanced models with its dense industrial base and proprietary data, but limited compute capacity and stricter regulation risk slowing scale-up compared with the U.S. At the same time, U.S. export controls and selective restrictions on leading models are prompting companies to adopt model-agnostic strategies and diversify suppliers to hedge against regulatory or geopolitical shocks. For markets, this creates a mix of opportunity and concentration risk. AI-related companies now account for a large share of S&P earnings. Semiconductors and infrastructure are benefiting from strong capital flows, and selective emerging markets tied to AI manufacturing are in focus, but heavy reliance on a single growth theme, elevated valuations, potential supply from capital raising, and rising political intervention all increase the risk of abrupt reversals. Upcoming earnings from AI-exposed firms, new regulatory steps, and evidence that productivity gains are spreading beyond pure tech will be key signals for whether this supercycle can run comfortably alongside a tighter Fed and a volatile energy backdrop. To sum up, a more hawkish and less predictable Federal Reserve is lifting front-end yields and compressing the curve, even as equities stay surprisingly resilient. At the same time, the Iran agreement has taken the immediate heat out of oil, easing near-term inflation pressure, but leaving a fragile equilibrium as inventories remain low and Iran's leverage over the Strait of Hormuz increases. On top of that, the AI capex supercycle continues to drive semiconductor and infrastructure names, deepen sector rotations, and raise both productivity hopes and valuation and policy risks. Together, these forces suggest a market dominated by cross-currents, where policy, energy, and technology each have the potential to reprice risk quickly as new data arrive. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.